Investment appraisal. Investment appraisal is a fundamental area in accounting that involves evaluating the profitability and financial feasibility of proposed investment projects. It helps management decide whether an investment should be accepted or rejected based on its expected costs and benefits. There are several methods of investment appraisal, including payback period, accounting rate of return, and discounted cash flows methods such as net present value and internal rate of return. Among these methods, net present value is considered the most important as it takes into account the time of value of money and measures the increase in shareholders' wealth. Investment appraisal therefore plays a crucial role in ensuring that limited resources are allocated efficiently and that investment decisions support long-term business objectives.
Today, I will explain the calculation of tax gain from disposal of an old asset and the initial outlay for a new asset. First, we calculate the net book value of the old machine. The formula used is cost minus accumulated depreciation. Cost of the old machine is Rm80,000 and the useful life is 10 years. So the annual depreciation is Rm80,000 divided by 10, then you will get the amount of Rm8,000 per year. The machine has been used for 5 years, therefore Rm8,000 times by 5 will get the accumulated depreciation of Rm40,000. Now we calculate the net book value. Remember, cost minus accumulated depreciation, Rm80,000 minus 40,000, and we get Rm40,000. Next, we compare the net book value with the sales proceed. Sales proceed of the old machine, Rm31,000. Net book value is Rm40,000. This results in a loss on disposal, which is Rm40,000 minus by 31,000, which is you get loss Rm9,000. Since there is a loss on disposal, the company enjoys a tax saving, the tax rate of 24%, and the tax saving amounted of 2,160. This tax saving will reduce the overall cash outflow. Next, we calculate the initial outlay, which represents the total cash required at the beginning of the project. We start with the cost of the new asset. Cost of the new assets Rm110,000, then we add all capitalized expenditures, consists of transportation cost Rm10,000, installation cost Rm30,000, training cost Rm20,000. Next, we add the working capital requirement, consists of working capital of Rm5,000. Now we deduct all cash inflows related to the old asset, consists of sales proceeds from old asset Rm31,000, tax gain due to loss on disposal Rm2,160. Final calculation of the initial outlay will get amount of Rm141,840.
Hello, my name is Muhammad Adil, and now let's take a look at the annual cash flow projections for year 1 through 5. This analysis helps us understand the net impact for the project on our yearly finances after accounting for savings, costs, and taxes. First, we look at our total annual savings. We are projecting an increase in sales of Rm28,800 and a decrease in operation cost of Rm8,800. Combined, this gives us a total savings of Rm37,600. From those savings, we must account for our expenses. We have an increase in depreciation of 6,000. That brings our net income before tax to Rm31,600. Applying a tax rate of 24%, which equals 7,584. That leaves us with a final net income after tax of Rm24,016. Finally, since depreciation is a non-cash expense, we add that 6,000 back to our net income. This results in an after-tax refreshment cash flow of Rm30,060 per year for the 5-year period. Finally, we look at the terminal cash flow, which represents the net cash recovered at the end of the project's life in year 5. We expect the salvage value of the new machine to be 80,000 at the end of the term. Additionally, we will recover the increase in working capital, which amounts to 5,000 ringgit. Combined, this results in a final terminal cash flow of 85,000, providing a strong finish to the project's life cycle.
Next, I will explain the investment appraisal using payback period and net present value. First, the payback period shows how long it takes to recover the initial investment. The initial outlay is 141,840 ringgit, and the annual cash flow is 30,016 ringgit. The payback period is 4.73 years, which means the investment can be recovered in about 4 years and 9 months. Next, the net present value or NPV is calculated using 10% discount rate. The present value of cash inflows from year 1 to year 5 is 130,784 ringgit, and the additional cash inflow in year 5 has a present value of 52,777 ringgit. The total present value of cash inflows is 166,561 ringgit. After deducting the initial outlay, the NPV is 24,721 ringgit. So, since the NPV is positive, the project is profitable and should be accepted. Next is internal rate of return or IRR. The formula used to calculate IRR is IRR equals the lower discount rate plus the positive NPV divided by the sum of positive NPV and negative NPV multiplied by the difference between the two discount rates. The project a discount rate of 10% give a positive NPV of RM24,721 ringgit, while a discount rate of 20% give a negative NPV of RM70,921 ringgit 66 cents. After applying the formula, the IRR of the project is calculated to be approximately 15.8%. For years 1 to 5, the project generates an annual cash inflow of RM30,060 ringgit and the total present value of RM89,765 ringgit 84 cents. In year 5, there is an additional cash inflow of RM85,000, which is discounted to its present value of RM34,161 ringgit 50 cents. Therefore, the total present value of all cash inflows is RM123,927 ringgit 34 cents. After deducting the initial investment of RM141,840 ringgit, the project results in a net present value of negative RM17,905 ringgit 66 cents.
Okay, for question C, based on your analysis in B above, advise whether ZenLife as the MBHD should replace the old machine. So, ZenLife as the MBHD should proceed with replacing the old machine as the investment is financially viable because the payback period of 4.73 years indicates that the initial investment can be recovered within an acceptable time frame. Second, the project records a positive net present value, which is NPV, of 24,721 ringgit, and showing that it will add value to the company and increase shareholders' wealth. Third, the internal rate of return IRR of approximately 15.8% is higher than the required rate of return of 10%, indicating strong profitability. So, based on the payback period, NPV, and IRR result, ZenLife as the MBHD is advised to replace the old machine.
Now let's discuss about SMEs. So what is an SME? An SME or small and medium enterprise is a business that operates on a small to medium scale. In Malaysia, according to the National SME Development Council, a business is considered as an SME if it meets either the number of employees or the annual sales turnover. The classification criteria are based on employees and sales. In terms of employees, a micro enterprise has 1 to 5 people, a small enterprise has 6 to 50, and a medium enterprise has 5 to 200. In terms of annual sales turnover, micro enterprises earn less than 300,000 ringgit, small enterprises earn between 300,000 and 15 million ringgit, and medium enterprises earn between 15 million and 50 million ringgit. A business only needs to meet one of these criteria to be considered as an SME. SMEs operate in several sectors, including primary agriculture, manufacturing-related services, and services such as ICT. They are also grouped by size categories, which are micro, small, and medium enterprises, depending on the number of employees or revenue, as I just explained before. SMEs are important because they contribute to economic growth by supporting business activities, create employment opportunities by providing jobs to society, and support national development by encouraging entrepreneurship and innovation.
For this section, I will review and summarize the main issues faced by SMEs. First, management issues. Most SME owners rely on experience rather than formal management knowledge. As a result, there is a lack of managerial skills, inadequate training, and weak human resource management. Next, financial constraints. Many SMEs have limited access to external financing, especially bank loans. They often face cash flow problems due to insufficient working capital and weak financial planning. Lastly, marketing challenges. SMEs commonly lack effective marketing and branding knowledge. They also have limited access for the market, weak business networks, and poor marketing capability, which reduces their competitiveness. To sum it up, Malaysian SMEs face major challenges in finance, management, and marketing. These weaknesses affect their survival and growth. Therefore, strengthening financial management, managerial skills, and marketing strategies is essential for the SME success.
The last question is, compute any two selected decision-making technique for the project. First, net present value criteria. If NPV is positive, the company should replace the old machine with the new one. Second is payback period criteria. If the payback period is less than or equal to the desired period, the company should replace the old machine with the new one. The payback period is equal with desired, which is 4.73 years. And the last one is rate of return criteria. If the rate of return is higher than or equal to the firm's required rate, the company should replace the old machine with the new one. Rate of return of this company is 13.8% is higher than the required rate, which is 10%.